Hi, and welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixture and journey towards financial freedom. They will cover financial products and also financial well-being so you, like me, can reach your aims and goals sometime in the future. Now let's get into this latest video. This video is about my self-invested personal pension plan. Now I do have a pension plan with my current employer, but I am restricted to the products and the contributions I can put in, so I've chosen to do my own funds and investments so I can create my own pension plan with the plan of retiring early very soon. Now, for those new, the plan is to make an annual growth returns of 10% for dividends during the year of £4,000 and a year-end portfolio value of £120,000. Now, I'm not here to sell anything, promote or recommend. It is my own personal decision makings, how the funds have progressed and the reasons why I hold them shares and the aims moving forwards. 2022 is somewhat sporadic, shall we say, markets are down, mostly over 20%, but a quick overview of the portfolio. At the end of September, the portfolio was worth £87,155, a loss year to date of 11.93%. The market in the UK is somewhat recovered during October. It's up 2.9% to the FTSE 100 and the portfolio is now worth £89,815, so a profit in the month of £2,660. Loss year to date has been reduced to minus 9.35%. Now, during the month, we made normal monthly contributions, which is £200 a month, and the government topped up with tax relief of £50, which is 25% extra. Fees were about the same. Monthly fees from our platform was £13.84 and predominantly UK based. Look at the following chart. UK and Europe makes up 84.48% of our portfolio. USA and Americas makes up 13.47% of our portfolio, and Asia makes up a tiny percentage of 2.05%. During the month we received some nice dividends, so total dividends of £145.82. Now we received £3,211 for the year to date, so we're near our target. We only record the dividends from the shares, all the funds are reinvested. But across our 15 shares, we've got an average yield of 4.07%. And a quick overview of what dividends received. So Greggs, the bakers, gave us £41.40. We reinvested that, we bought 2 new shares. And Drax, a biomass maker, gave us £99.87. Again, we reinvested 17 new shares. And AG Bar, the drinks provider, gave us a very tiny dividend of 4.55 pence. Not reinvested because it's just not economically worthwhile. Let's delve into what sort of holdings or shares we hold within our portfolio. So look at the following chart, an overview of our shares. So we own 15 shares. Now down to 6 in profit, 9 in loss. Total share values of £71,449, of which 69% is in the FTSE 100 and 10% is in the FTSE 250. Now our largest shares are mainly bank based. So Aviva, 4,320 shares, £18,000, makes up 20% of our portfolio, but it's safe, it's secure, it's boring, it's giving a very nice yield of around about 7%. Our next holding is Lloyds, the banking group, 33,286 shares, virtually £14,000, 15.5% in our portfolio. Did have very good results in the quarter, profit margin increased, but unfortunately bad debt provisions when increased, the market did not react very goodly. So the shares took some kind of a rebound during the month, but very good fundamental results. Our next holding has somewhat struggled recently due to some bad press. It's Drax. We now own 1,206 shares, £6,300, down to 7% of our portfolio. It was showing a profit of over 100%, it's been reduced, but very cash rich, gave us a nice dividend of £100 during the month. Our next holding has increased during the month, very good results, very good trading statement. It's Greggs the retailer. 278 shares, £5,600, makes up 6% of our portfolio. Our next holding is HSBC, 1,076 shares, £4,800, 5% of our portfolio. Very good results during the month. Okay, is away from our UK focus, but it was done for a reason, away from, shall we say, a greater, wider audience across the banking sector. But again, dividends being increased, profit margin being increased. And our next holding again is another banking share. It's Barclays, 2,941 shares, £4,500, makes up 4.8% of our portfolio. Again, very good quarter, very good trading result, very good improved margins, and it has made some kind of increased debt provisions because of what's happening in the UK banking sector and consumer confidence. Next holding is one we've been increased lately, is Legal & General. We now own 1,731 shares, £4,000, 4.4% of our portfolio, and we did buy another 123 shares in the month for a valuation of £340. Some shares that have done really well lately is Shell. We own 150 shares, £3,600, and BP, 542 shares, £2,600. But they've had both very good trading results. Okay, profits have gone through the roof, dividends will be increased substantially, and they will be doing some kind of share buybacks. There is a bit of hoo-ha, shall we say, about a so-called windfall tax. Shell will not be participating, shall we say, because of where it's based, but BP will be affected. But excellent results during the month. Other shares we own of note, we own JD, 2,500 shares, £2,400, makes up 3% of our portfolio. And lastly, Sainsbury's, 1,174 shares, £2,300, 2% of our portfolio. But hopefully, we're expecting some good results out later on this week. Who knows what will happen? Tesco's have good results. Will Sainsbury's follow suit? And other shares we own, shall we say, on a smaller note, Pennon, the water company, which has struggled lately. AG Bar, the drinks provider, did have very good results, did give us a small dividend a month. AJ Bell, the platform provider, again, did have very good results during the month. A lot of new subscribers. Assets under management have been increased because of obviously market valuations, but a very long-term player. And Card Factory, the retailer, again, very cash rich. It is reducing our debts, but it makes up a tiny percentage of our portfolio. So, just to summarise, 15 shares. Some were some very good results in the month, but unfortunately, a lot financial based has been affected because obviously the recent mini budget and what's happened, and sentiment across the UK banking sector, and so-called bad debt provisions that they will be taken, or assumptions to be made in the coming months. Now, moving across to the funds we hold. Quite restricted, shall we say. We own 6 funds. Now down 2 in profit, 4 in loss. Makes up 20.39% of our portfolio. Total fund values, £18,293. Largest holding is a Legal & General Technology Fund, £6,200, 7% of our portfolio. It was bought for diversification across numerous large global players across the tech industry without holding individual stocks, so it was done to reduce risk. Next holding, again US based, shall we say, is a US smaller companies, £3,900, 4% of our portfolio. It has been a very good performer until recently. Next holding is quite selective. Bally Gifford Positive Change, owns about 35 shares, £3,200, 3.5% of our portfolio, and it was showing a very nice profit until recently. Next holding is somewhat UK based and focused. It's a Lindsell Train UK equity fund. £2,500, 2.7% of portfolio, has struggled lately, but it's got an excellent track record over the last 10-15 years. It owns quality companies, safe, secure, guaranteed, which all of say are considered reliable, steady, and have what we call a secured moat. Okay, the good market leading positions. We own a global growth fund, £2,000, 2% of our portfolio. Okay, has struggled lately because it's a global growth, but again, it was done for diversification. And then our last fund has somewhat struggled. By far our worst performance is a UK smaller companies. We put £1,000 in. It's now worth £688. Thankfully, it makes up 0.77% of the portfolio. Normally, smaller companies will outperform larger companies, but it has struggled because of what's happened in the UK in the last 12 months. But it's seen as a long-term buy. So, a fair mixture, shall we say, of 6 funds. Some good, some bad, but all bought for a specific reason. All long-term holds, and we show no reasons why we're going to sell any shares or any funds based upon current scenarios. So it's not a get-rich-quick scheme. The aim is to make 10% year on year, and as we found out through the chart right at the start of the video, we will have some good months, we will have bad months because of what is happening about market sentiment, but my own personal view is avoid short-term noise. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.